The real story behind the silver crash. Feb 2026. This market is not acting like a normal free-flowing market anymore. In mid-February 2026, global silver prices experienced one of the most dramatic breakdowns seen in years. In a matter of days, prices that had reached record territory, above $115 an ounce on some exchanges, plunged by more than 30% across major futures markets, shocking traders worldwide. Silver futures that were trading above 115s in early February found themselves collapsing below 75 per ounce by mid-month as markets shifted dramatically. Spot prices in many regions, including India and the US, reflected this abrupt drop with heavy losses in mining stocks and exchange-traded products. What caused such a dump? There isn't a single reason, but a combination of forced liquidations, technical market shifts, and speculative positioning. 1. Mass liquidations. Triggered by margin policy. Exchanges, like the CME Group, raised margin requirements on silver positions dramatically. This meant traders needed more collateral to hold their positions, and many couldn't meet those requirements. The result, automatic sell orders and forced liquidations, which cascaded as prices fell. 2. Liquidity thinning. During closures. China's major precious metals exchanges were closed for the Lunar New Year. With thin market participation, price moves became exaggerated, and paper markets, futures, swung violently. 3. Retail and leverage positions. Crushed traders who had bet heavily on further price advances, weekends, were forced out of positions. Once stop-loss triggers and margin calls hit, selling snowballed, not necessarily because fundamentals worsened, but because markets structurally amplified moves. Is this normal market behavior? No. And that is precisely why so many traders are saying this is not a real market anymore. In a normal market, price changes reflect supply and demand fundamentals. Industrial demand, mining output, central bank policies, macroeconomic trends, etc. But here it's assumes what we observed: sharp divergence between paper markets, futures prices, and physical markets where actual silver is bought and sold. In many regions, premiums remained high even as futures collapsed. Exchanges raised risk parameters mid-move, pushing prices lower without new physical supply coming in. Massive volume spikes where huge amounts of contracts exchanged hands during sell-offs, yet liquidity dwindled. That's the kind of behavior traders associate with manipulation, forced liquidation cascades, and structural distortions, not normal price discovery. Manipulation claims. What's really happening? There are two big narratives: institutional pressure and paper shorting. Some analysts and commentators point to large institutions, including big banks and futures traders, taking strategic short positions at the top and covering them at lower levels once prices started falling, capturing profits while triggering liquidations among smaller traders. This echoes previous accusations of paper market dominance, where massive futures positions can overwhelm the price signal from the physical silver market. Tumors, not enough physical support. At the same time, physical demand, especially from industrial buyers and bullion investors, has been strong. Global silver is in a structural supply deficit, meaning more silver is consumed than produced annually. Even as paper prices crash, real demand persists, and vault inventory has shrunk rapidly. This disconnect, heavy selling in paper markets while physical markets remain tight, makes it feel like the market is broken, or not real because prices are being driven more by financial mechanics than by physical demand and supply. Fundamentals still matter. Despite the crash, structural silver demand hasn't disappeared. Industrial use, especially in technology, solar panels, and EV infrastructure, continues to grow. Analysts still project years of sustained deficit in supply versus demand, which underpins long-term price support. Even amid sell-offs, some buyers see opportunistic entry points near classic support levels. This means the crash might be technical and driven by trading dynamics rather than the metal fundamentally losing value. So, is the market real or manipulated? It's both. Real fundamentals still exist. Physical demand, supply deficits, industrial use, these forces are still intact. But the price dynamics now reflect structural distortions in the financial markets. Leverage, margin policy decisions, thin liquidity periods, and heavy speculative positioning. That can make the market feel unreal to participants, especially retail traders who get squeezed when big players adjust risk models mid-move. What this means. Going forward, in the short term, expect volatility. Waves of selling, followed by sharp rebounds as technical support levels are tested. In the medium term, if physical demand continues to outpace supply, the disconnect between paper prices and real scarcity may eventually correct, possibly leading to renewed upward pressure when forced liquidations stop. In the long-term metal fundamentals and industrial demand drivers remain strong. But investors and traders should not expect pure, old-school, free markets anymore in highly liquid futures markets like COMEX. Story 1. Silver crash. Explained, a global liquidity squeeze and massive 1.28T wipeout. In the past week, the precious metals complex, especially silver, has experienced one of the most violent corrections seen in years. After surging to record and near record levels late in 2025 and early 2026, silver prices across global markets crashed sharply in February. Markets saw a flash crash in both gold and silver, with prices plunging in a volatile session that reflected not just profit-taking, but structural stress in commodities markets. According to market reports, about $128 trillion in value was wiped out from gold and silver markets as liquidity tightened and trading conditions became unstable. Silver prices were pulled down by rising bond yields, a stronger US dollar, and thinner market liquidity due to major Asian exchanges being closed for the Lunar New Year. This tug-of-war between market mechanics and global financial dynamics triggered fast, sharp moves that punished leveraged positions. In India, this correction is particularly visible. Silver futures slid over 35% from recent peaks, hitting fresh 2026 lows in key cities, even as buyers hesitated for further drops. Despite occasional short-term rebounds in gold and silver prices, like a jump reported today in MCX silver prices, the overall sentiment remains cautious amid continued volatility. Why this matters? Markets aren't just correcting, they're undergoing a liquidity-driven reset. When major financial centers close and dollar strength increases, non-yielding assets like silver can be hit harder than expected, triggering algorithmic selling and margin stress that leads to cascade dumping. This picture is much deeper than simple profit-taking. It reflects systemic liquidity conditions and a shift in global investor positioning away from precious metals. Story 2, why the silver sell-off is not just normal market behavior. The recent plunge has stirred panic among investors and ignited debate about whether the silver market is broken or even manipulated. Here's what analysts and traders are saying right now: margin changes and forced liquidations. One of the biggest technical drivers of the drop was a sudden adjustment to trading margin requirements by major futures exchanges. When exchanges increase the amount of capital traders must hold, leveraged positions get liquidated quickly, and that selling pressure instantly translates into fast price moves lower. Analysts refer to this as a margin-induced sell-off, not a classic supply-demand correction. Shanghai premium flip. For months, silver prices in China were trading at a significant premium over Western markets, a sign of strong physical demand. Then, inexplicably, that premium vanished and even turned into a discount. This Shanghai flip is seen as a critical signal that the physical support under prices disappeared temporarily, making paper markets even more vulnerable to downside pressure. Global dollar strength and rate expectations. Another key force pushing silver lower was the broader macro backdrop. A stronger US dollar makes dollar-priced commodities weaker because they become more expensive for non-US buyers. Expectations about US interest rate policy shifted markets from betting on rate cuts to pricing in a higher for longer stance, reducing the appeal of non-yielding metals like silver and gold. Retail and speculative cascade. Retail and leveraged traders who piled into silver during the rally found themselves on the wrong side of the move when price momentum reversed. Stop-loss orders and margin calls forced many to exit at a loss, adding to the selling pressure and accelerating the drop. This dynamic feels almost like a controlled unwind, not a smooth price discovery process, which is why so many market watchers are saying flatly that it doesn't feel like a normal free market anymore. Big picture. Current dynamics shaping silver. Not a simple reversal. The silver market is being buffeted by multiple powerful forces, not just buyers and sellers balancing supply and demand. Financial conditions, dollar strength, bond yields, liquidity cycles in major trading hubs, exchange margin policies, divergence between physical demand and paper pricing. This mix has shaken markets worldwide, and although some short-term rebounds are possible, the current environment remains unpredictable and volatility-prone. They dumped silver again. Is Wall Street resetting the market? February 2026 will be remembered as the month silver traders realize something important. This is no longer a smooth, organic market. It's a battlefield. Just weeks ago, silver was riding one of its strongest rallies in years. Bulls were confident. Retail investors were flooding into metal ETFs. Mining stocks were climbing. Social media was filled with predictions of $120 silver. Then suddenly, the floor vanished. Within days, silver plunged violently across US futures markets. Traders watched in disbelief as price levels that took months to build were wiped out in hours. Charts didn't show a pullback, they showed a collapse. And the question spread everywhere. Was this a normal correction or a coordinated dump? The crash that shocked COMEX on the US futures exchange The selling began quietly. Volume started rising during thin trading hours. Then came the avalanche. Large blocks of futures contracts hit the market. Not gradually, but aggressively. The kind of size that doesn't look like retail panic. The kind of size that forces prices lower instantly. Silver broke key support levels. Stop-loss orders triggered. Algorithms accelerated the move. Within 48 hours, billions in paper value disappeared. For many traders, it didn't feel like supply and demand. It felt mechanical, forced, engineered. And the timing? Interesting. Margin hikes. The silent trigger shortly before the collapse, futures exchanges adjusted margin requirements. That means traders suddenly needed more collateral to hold their positions. For heavily leveraged accounts, this is devastating. When margins increase, traders must either deposit more money or liquidate positions. Many couldn't deposit fast enough. The result? Automatic selling. The selling pushed prices lower. Lower prices triggered more margin calls. More margin calls triggered more selling. A perfect cascade. Was it manipulation or just risk control policy? Officially, it's called risk management, but to traders who were wiped out, it feels different. It feels like the rules changed mid-game, the dollar factor at the same time, the US dollar strengthened sharply. When the dollar rises, metals priced in dollars often fall. Silver doesn't yield interest. So when bond yields climb and rate expectations shift higher for longer, capital rotates out of metals. But here, it's what's interesting. The dollar didn't spike enough to justify the magnitude of silver's fall, which means macro pressure explains part of the move, but not all of it. Physical versus paper. The disconnect. Here's where things get even more fascinating. While futures markets were crashing, physical silver demand remained steady. Dealers in multiple US states reported continued interest in coins and bars. Premiums didn't collapse at the same speed as futures prices. That creates a gap. Paper silver, futures contracts, traded aggressively lower. Physical silver didn't flood the market. So what actually changed? Not supply, not industrial demand. What changed was positioning. The speculative unwind silver had become crowded. Retail traders were long, hedge funds were long, social media momentum was strong. When a market becomes one-sided, it becomes fragile. All it takes is one trigger. In this case, margin hikes, dollar strength, profit-taking by early institutional buyers. Once early large holders started exiting, liquidity thinned. Thin liquidity makes price swings larger. That's when the real acceleration began. It wasn't necessarily a conspiracy, but it was a structural vulnerability, and structure can be just as brutal as manipulation. Why it feels not real. Markets today are dominated by high-frequency trading, algorithmic execution, leveraged derivatives, institutional positioning models. When silver drops 10% in hours, it's not miners suddenly producing more metal. It's not factories canceling solar panel orders. It's positioning models recalibrating. That's why traders say this isn't a real market anymore. Because price discovery no longer looks human. It looks automated, cold, mechanical. Who benefited? In every violent move, someone profits. Short sellers who anticipated a technical breakdown likely covered at lower levels. Institutions that reduced exposure before margin changes protected capital. Volatility traders thrived. But leveraged late entry retail traders? They absorb the damage. That imbalance feeds the narrative that silver is controlled. Whether that belief is accurate or emotional, it spreads quickly during sharp downturns. Is this the end of the rally? Not necessarily. Here's the key. The long-term fundamentals of silver haven't disappeared. Industrial demand in, solar infrastructure, electric vehicles. Semiconductor production remains structurally strong in the US and globally. Mine supply growth hasn't exploded. Deficit projections still exist in several analyst outlooks. What changed was the short-term financial structure, and markets often overshoot during structural resets. What happens next? 3 scenarios are possible. Technical rebound. If liquidation pressure has largely cleared, silver could stabilize and bounce sharply as short sellers take profits. 2, extended volatility. If dollar strength continues and bond yields stay elevated, metals may chop sideways with high volatility. 3, deeper correction. If macro conditions tighten further, silver could retest lower structural support levels before rebuilding momentum. The real lesson. The February 2026 silver dump wasn't just about price. It exposed something deeper. Modern commodity markets are hyper-leveraged ecosystems. When stress hits one node, margins, liquidity, macro shifts, the entire structure reacts instantly. It's not the silver bar in a vault that moves first. It's the derivative contract on a screen. And until leverage normalizes, volatility will remain extreme. Final thought, did they dump silver? Large players definitely sold. Margin mechanics definitely accelerated. Liquidity definitely vanished at the worst possible moment. But whether it was a coordinated attack or a systemic unwind depends on perspective. One thing is certain. Silver just reminded the market that leverage is powerful and unforgiving. And in 2026, the silver market is no longer slow and steady. It's fast, it's technical, and it's ruthless.